It was a difficult year for stocks and bonds, but there are several silver linings. What will happen now with rates and inflation? What do economists say about whether or not there will be a recession? What are updated expected 10-year returns for stocks and bonds? How is cryptocurrency similar to the Dutch tulip craze of the 1600s? That and more in today's Quarterly Context webinar. Welcome to WealthStep's Quarterly Context webinar for the fourth quarter of 2022. WealthStep is an online financial guide to help people in 401k plans and other individuals make smart decisions about how much money they need to retire and how much to save and invest to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior, learnings, and patterns to help you stay more relaxed by staying well informed and therefore make better decisions towards your goals. We post this to the blog at wealthstep.com. Please pass it on to people that you think it might help in terms of helping achieve retirement readiness. So as usual, we have two parts. One is current information and then a quick review of general steps towards financial independence. As always, the overall theme we hope you will keep in mind to get you towards your big financial long-term retirement readiness goals are the idea of aim, save, and invest. Aim is figure out how much you'll need at the time you'd like to work less or stop working. Save is how much you need to save now, and invest is how to invest between now and then towards that retirement readiness. One of the key things for the most successful savers and investors is to focus on the things that matter and where that overlaps with the things you can control. You can't control markets, you can't control how much you save and how you respond in a disciplined way by being a disciplined investor, even in difficult markets like was the case in 2022. So it's key to, again, define your goals, save, think about investing from a life stage approach rather than a random or shifting approach, diversify well, and stay on track and stick with your plan even during market bumps and dips. So part one, we'll cover some current topics. Ongoing news has been about continuing high inflation, although it's cooled, some continuing interest rate hikes that the Federal Reserve is enacting in order to control inflation, although those interest rate hikes have become in smaller increments. And overall, it was a strong fourth quarter, but overall a difficult 2022 in terms of both stock and bond returns. We'll see more about those specific returns in a moment. Overall, the Fed raised rates 7 times in recent periods, a total of 4.25% to try and control inflation. As rates go up, that has a negative impact temporarily on bonds. So there was an unusually difficult bond year for 2022. The stock market overall was down 16%. In terms of the large cap US stock market. The bond market, as mentioned a moment ago, difficult year, one of the worst years ever for bonds. However, those higher rates will cause future bonds to have higher returns. So there is some reward for that risk moving forward. And overall, the economy in terms of economic growth for the US is estimated to have been about 0% in 2022 and still a relatively flat 1.5% for 2023, whereas a more normal growth level would be in the 2 to 3% level. Stocks, as you can see here, and bonds had a difficult 2022, down from 14 to 25% in stocks and 10 to 13% for bonds. So unusual to see all the arrows pointing downward for a whole year period, but that does happen on occasion. During the quarter, however, quite strong, so 7 to 16% returns, with international stocks doing the best after a period where international stocks had been relatively weak because the dollar had been strong, but the dollar pulled back a little bit. That helped with the foreign currencies adding to international stock returns. And even bonds had a positive quarter, up almost 2%, which is quite strong for a quarter. And if we look at stock returns in the US and also globally for the last 10 years, you don't see any red numbers there. All positive and all ahead of the last 10 years projections, despite the difficult 2022, and in some cases ahead of long-term averages. So it's valuable to remember that a difficult year in the context of a full 10-year period, if you had done planning and investing over that full time period, you would still be ahead of the game if you were a disciplined investor. So don't pay too much attention to the short-term bumps. Don't let that make you too nervous and cause you to change your investment strategy if you have an investment strategy that is appropriate for your life stage in terms of the stocks and bonds mix. This is called a histogram. It shows the different returns over the last 100 years, almost back to 1926. We can see that 2021 was one of the stronger returns, if we see it in terms of overall history, and 2022 was the 7th worst for stocks. So great year followed by a tough year, but overall, because the last 10 years was unusually strong, even though there was that negative return and some couple of tough returns along the way in the last 10 years, still up 12%, more than 12% over 10 years and almost 10% over 5 years. This chart shows the market and how in 2020 stock market had a big boost right around the time that the government injected about $5 trillion in stimulus into the economy by providing funds to businesses and individuals to help survive the COVID crisis. That caused indirectly the inflation boost, but also a big market boost. And where it's come back to around now is right about where it should have been all along. So you can think of that initial boost as a market overreach, and now things are cooling back to normal. If we look at the current mustard line here, the current last year of a weak market looks pretty similar to the global financial crisis of 2008 in terms of the overall pattern and drop over that first year, and similar to the dot-com bomb market of the early 2000s. The global financial crisis market and the dot-com markets got significantly worse after that point. However, there is some reason for optimism for the current market in that even though it could get a little worse before it gets better, there is a chance that because these other two markets were the dot-com market was a big pricing bubble where prices went way out of whack for stocks, and the global financial crisis was a financial system crisis. The current market has been caused by the Fed manually increasing rates. So it's a bit of a man-made problem, and the Fed could reduce rates if needed, although it's a little tricky for them to thread that needle and do it exactly in the right way. And this year was the COVID crash that subsequently had a very fast recovery. So that's one of the fastest drops and fastest recoveries ever. So will there be a recession? Many economists think so. We might even be in one right now. There's a group of economists who continually look at the economy and determine, looking backwards, whether or not there was a recession. So by the time it's been decided whether or not there is or was a recession, sometimes we're already past the worst of it, and oftentimes, more often than not, we're past the worst part in the stock markets, and the stock market recovery has begun. So keep that in mind. If people are talking about recession, some investors may panic. Don't panic because you want to focus on the long run. Inflation has, of course, been a big topic, has cooled a little bit, but still relatively high. So the Fed, as a result, will continue to raise rates, although in smaller increments, which will cause some volatility in the marketplace. So that's expected and normal. Unemployment has been stubbornly low, which is good for the economy in general. However, the lower unemployment is, the more likely consumers will continue to spend, and that can boost inflation or prevent inflation from coming down, which may lead the Fed to raise rates more. The Fed is hoping that unemployment will rise just enough to control inflation, to prevent the inflation from doing more long-term damage to the economy. The federal funds rate, you can see over the years, over the decades, has gone up, and then the last 3 or 4 decades, 3.5, has come way down, near zero for most of the last 12 years or so. Ratcheted up just before COVID and brought it back down to as stimulus during COVID to help keep the economy going, and now is ratcheting back up to control inflation. And now we're at more normal, some level that's a little closer to longer term, but it's a painful way to get there because, again, as rates rise, that has a negative impact on bond prices temporarily. That negative price with that big rise led to one of the biggest drops ever in terms of bond returns, but already that has started to improve. It could be a little bumpy along the way if there are additional rate hikes, but more likely than not, we will not be seeing any negative returns like this 13% or so plus drop over the last year anytime soon again. Stock valuations means our stock prices relatively high or relatively low. When they're relatively high, as they were a couple of years ago, that's typically followed by a cooling. You don't know when that's going to happen or how fast, but it normally does at some level, and that has happened. Now stocks are at a more normal level, not dramatically underpriced like they were after the global financial crisis, but at much more reasonable levels, and that would generally suggest that there should be lower volatility than the last year moving forward, although don't be surprised if there's some volatility along the way. Consumer sentiment, the way people feel about the economy impacts how they feel about their spending. Was at a long time low last quarter, has improved a little bit this quarter. That's good news in general for the economy. However, again, if consumers are overconfident, which they don't seem to be, but if the confidence is too high, people spend more, that could lead to sustained inflation, which could lead to more interest rate hikes by the Fed, and that can lead to a bumpier economy and market. Overall, you can see the volatility numbers tend to spike when there are big crises. Right now, we're at somewhat elevated levels, but a little bit closer to normal, whereas for a number of years here, volatility was unusually low. That's not normal. It's a little bit more normal to see something a little bit more like I've seen in the last few quarters in terms of that back and forth. COVID is continuing to improve, had a bit of an uptick, and the reason we show this is that it does affect some of the news and economies and supply chains, whether it's in the US or China, although overall supply chain factors related to inflation have improved. The good news is that even though there is a continuing level of COVID, the rate of deaths has dropped significantly over the last few quarters, which is, of course, good for avoiding sad news and heartbreak, and is also generally viewed as a good sign for the global economy. Let's talk about cryptocurrency for a moment. There are some people who are familiar with the tulip mania in the Netherlands in the 1600s, and there are some interesting parallels with the cryptocurrency dynamics in the last year. A lot of cryptocurrencies have dropped 70 to 80 to 90% in value after a bumpy ride, but very bumpy but rapid rise, sort of meteoric rise upwards. A lot of people thought that those prices and cryptocurrency prices could only go up. But as it turns out, and as we talked with people who would ask us if we recommend holding a dedicated exposure to cryptocurrencies in a portfolio, that it isn't really an asset class in our view. It's more of a fad. And while there are important elements where crypto type currencies and other blockchain technology impacts on industries could have a big impact, positive impact in the future. Currencies in particular don't really have a lot of really underlying intrinsic value. They're not producing something of value. They are just a transmission of value. So the prices went up as people thought they were going to keep going up, and it created a bit of a bubble. Not unlike maybe the dot-com boom to some degree, but an even more dramatic case as the Dutch tulip mania in the 1600s. Even professional traders got involved, and at the peak, when there seemed to be a shortage of tulips and excess demand, the price of tulips became equivalent to what it would cost to buy a house or a mansion in the Netherlands. Again, because people thought that it could only go up. And in that case, and as has been the case in some other bubbles over history, some people borrowed in order to buy, to tap into that excitement, but then were sadly crushed in 1637 when people realized that tulips were not worth the price of a house and dropped around 90 to 95%. So key lessons are be aware of things that look too good to be true, of things that are just trends. And if you do insist on investing or putting money in something like that, there's a difference between investing and speculating. So be clear about money that's your serious money that you're counting on in the future, and what you might consider to be play money, which is money that you can afford to lose. You can afford to go to zero without ruining your retirement plans or your financial independent plans or any other important plans to you. Again, the difference between speculation and investing is very important. We mentioned at the beginning, their projected return increases. Stock projections have gone up for the next 10 years relative to last year's 10-year projections, given what's happened in terms of market cooling. The more markets cool, the higher the returns tend to be in the future because markets are cyclical. So stocks on average have gone up about 0.75% in terms of projection. Bonds have gone up considerably more, around 2.5% to 3% across a number of bond asset classes. So the good news there is that bonds will have higher returns in the future, higher yields, and that elevates overall between stocks and bonds an expected increase in return for investors over time. That concludes part one. We'll do a quick review of part two, just as helpful reminders. Keep your eyes on the decisions that matter most. Make sure you're saving enough. Focus on those basics. Maintain a budget and make sure you pay yourself first so that you're saving for your future and not just putting money in someone else's pocket for things that you're purchasing. Maintain a portfolio stock bond mix that's appropriate for your life stage. And be careful about risks. Volatility is not the only risk. Inflation, as we've seen, is a risk, and being a disciplined investor is one of the best and only ways to offset that inflation risk. There are other factors to consider as well, and you can see more about that on the video, education video on the WealthStep.com blog. General rules of thumb, get to know the number that you might need. How much are you going to need to begin your retirement? Most people should be saving 10 to 15%, and oftentimes more. Sometimes a little bit less if you start early enough and you don't have huge spending plans in retirement. And if you started late, 10 to 15% might not be enough. So figure that out so that you get on track so that you don't have to make big adjustments in retirement, end up dramatically reducing your spending or your lifestyle. And then invest by life stage, fairly simple way to approach it, and stay disciplined. Don't let the bumps in the market cause you to be an emotional investor. There's some things that people have told us over the years when we've done 401k type education meetings. Key points are here. Some people, the younger people are, the less important they think it is to save, and they think they'll do it later. The later people are, they wish they had started saving a little more or a lot more sooner and could have done it but didn't do it, didn't realize it was important, and then if you get to a much later age, it's a lot harder to catch up, and in some cases can be impossible to save enough to live the lifestyle you want to live. So anything you can do now, regardless of age, will help. The sooner you start, the better. In terms of maintaining expectations, this includes the updated capital market expectations mentioned a moment ago. Long-term averages are still higher than these projections. So you want to be aware of what the shorter term numbers projections are, so you have reasonable expectations in that process. And remember, even if it seems easier to be in cash or something short term, you're giving up a lot of return and don't do that much better than inflation, if not doing worse. So even if stocks and bonds are bumpier than cash or something in short term, it's really important to have that exposure in your portfolio and the right life stage approach to help you get where you're going to go, in addition to having the right amount of savings each year. The same asset class categories, you can see, even though it's bumpier, stocks have a long-term payoff. You see a lot more return over time. Bonds in the middle, cash would be a little bit below that, and inflation are around the same cash level. So it looks smoother and easier to be in bonds or cash only, but generally you want to have a blend, again, that matches your life stage so that you have a diversified mix, have a return level that is appropriate for your life stage and your goals. Some people aren't disciplined about their investing, unfortunately, and that leads to real self-damage in terms of accounts. There's a study that showed 8% return over this 20-year time period. The investor return was about half that, because people were moving in and out of fear and concern, and ended up selling low, missing the recovery, for example, and ending up with less return. So it's better to just find the right strategy for life stage and stick with it. So to summarize, aim, set your goal, figure out the plan that makes sense. You can use online tools like WealthStep will be providing, or a financial planner. If you find one on your own and use someone that's fee only, that doesn't use try to put you in specific products. Save the right amount. A good general rule of thumb is 10 to 15%, but some should save more than that, and a few may be able to save a little less. Invest by life stage. Spend based on a plan within your means now, and then using a specific spending plan so that you don't run out of money too soon once you are relying on your savings for all of your income. And pay attention to the right risks, fighting inflation, rather than just avoiding market volatility, because you need some market volatility in order to generate that long-term return. So thank you for being with us today. We appreciate your attendance. Pass this on to others you think it might help, and thank you for being here today.